On today's video, we're gonna talk about the one major factor I think is more important than interest rates that are actually gonna be affecting the housing market. What's going on? Adam Schwarz here, top real estate agent. If this is your first time to my channel, every single week I drop videos about real estate, so make sure you hit that subscribe button, also hit that bell button so you don't miss any of these videos. On today's video, I'm gonna talk about what the one thing I think is going to affect the housing market actually way more than rates, because we've seen high rates in the last 2 years actually see pricing go up, and I think this is actually going to bring pricing down. And especially in California, I don't know if you saw this last article, but housing insurance, State Farm is threatening to leave the state of California unless they're able to raise homeowners insurance by 30%. And it's not because they're trying to, take more money. The problem is the cost of fixing your home, cost of labor, cost of supplies, all of that has gone up 30%. So basically they're just trying to equal up to where it would cost to rebuild your house if something happened. So this is the idea I'm talking about. So in 2019, we're just playing with fake numbers. These are all fake numbers, but this is the idea I want you to think about. So in 2019, say your income was $8,000, say housing was $2,000, food for the $1,000, gas was $500, and say others was $2,500. So you're making $8,000, you're spending some money, you got $1,500 left in your pocket. The problem is, because of inflation, we've seen prices of everything go up. Groceries are more, gas is more, insurance are more, like we just talked about. But most people are on a fixed income, especially the elderly people. They only make a certain amount of money per month. Most hourly or salary people, they only make a certain amount a month. So now, say in 2024, your income stays the same, it's $8,000. Say your housing stays the same, because a lot of people are like, oh, well, I have a 2.5% mortgage rate, or I have a 3% mortgage rate, fixed rate, 30% year. Agree, that will stay the same, but now your food's $1,500, now gas is $1,000, and then say others is $4,000 a month. And so now you're in a negative $500 a month. And so yes, your income stays the same, and yes, you have a really low mortgage, but everything else has gone up. So what do? Now you're in the negatives. So now you're negative money. So one, put stuff on credit cards. That's the first thing you can do. Get a second job or stop spending. So if you look at one of the last articles that just came up, we are at the highest US credit debt of all time, right? So definitely people are putting a lot more stuff on credit cards. Why? It's because things are costing more and their income is staying the same. No one puts their stuff on credit cards at 27% interest if they have the money in the bank. They just don't do it. They might have money in equity, but you can't pull from that equity unless you sell your house. And you're not gonna refi, because then you get just 7% credit. But that's another video I think that is an important thing. Second thing is, the reason why we've seen unemployment stay so low, we've actually saw unemployment jump up to 4.1 the last few days, but people are now getting secondary jobs to be able to pay for the inflation. Or people stop spending. And when you stop spending, what then happens then? When you stop spending, well, that's when we see a recession. So people stop spending. So then if I stop spending at a small business, and then those people are unable to pay their employees because they're not having the same income, what do? Let people go. And so then we see people lose their jobs. Then they can't afford things. And then what ends up having to do? They end up having to sell their house, take all that equity, and live off that. And so then we'll see an increase of houses hitting the market. And so I want you guys to think about it like this. Right now, and since honestly 2020, we've seen 10 houses for every 100 buyers. And so that's obviously forced the prices go up. More demand than supply. But if all of a sudden we start seeing these things start trickling down where inflation is costing people too much money, then their house is gonna be put on the market. People are gonna be losing jobs because they're also stopping spending. And so now you're gonna go from having 100 houses on the market and only 10 buyers looking to buy, and what goes in? Prices goes down. It's very simple, supply and demand, right? So that's something we need to start worrying about, is that sooner or later, people's income are staying the same. Yes, their mortgages are staying the same, but everything else is still going up. And what people don't wanna think about is that yes, we've seen inflation come in control, but that is just increasing pricing. So if the Fed gets back to their goal at 2% increase per year, that's great. That's slowing the inflation down, but that's not counting towards how much stuff has gone up since 2022. So those people that are already stretched thin, unless they go get another job or stop spending money, what are they gonna do? And that's the sad part that we're really seeing right now is, say you're on a fixed income, say you're retired, fixed income, yeah, maybe even your house is paid off, but now your house is now worth $700,000, you're sitting on $700,000 of equity, but now your insurance goes up or your taxes go up, and these things go up. Well, your Social Security's not going up and your retire's not going up. And then so what do? You have to sell your house and move out of state or downsize and take that equity and live off that. So hopefully this video helps. I think this will be more important than interest rates, because we've seen rates go up, and look, people are still buying, houses are still hitting all-time highs out here in Southern California, but sooner or later, this overspending and the high inflation will start making a lot of people that own homes, baby boomers, start thinking, hey, can I afford this house anymore, even though it might be paid off or have a really low interest rate. So if you have any questions, please comment below, and until next time, peace.